Oof, we just wrapped up a really bad week in the stock market. In this episode, I want to take a quick technical analysis look at the S&P 500 to figure out how this unfolded and where the market overall might be headed next. Here's the S&P 500 chart that we have currently. Notice that we've been in a strong bull market starting all the way back in October of 2022. From this 2022 low to this high here at 5669 that we set back in July of this year, the market has advanced 62.4%. Also note on this chart the summer correction that we had last year, which lasted about 3 months. I consider this and the April dip that we had this year to be corrections in the stock market, not necessarily a bear market. For my rather informal analysis of bull and bear markets, I consider correction to be rather shallow. So, for example, last year's decline in the summer was only about 10%, and they're relatively short-lived compared to a true bear market. By short-lived, I mean lasting from a few weeks to a few months. For a true bear market, I consider that to be a long trending decline that could last a year or maybe more than that, and we have a much larger amount of decline, such as a 20 to 30% or 40% dip in the index. What I'm trying to figure out is if this candle that we have here, if that's going to be another summer correction like we had last year, or is it the start of something of a more protracted decline like we did in 2022 when the tech stocks collapsed. Now, if you recall, I recently did a video exploring bull and bear markets of the 1950s. Using that information, that methodology of looking how the market advances and then declines, let's try to put the current bull market into a bigger context of previous bull markets. Here's my spreadsheet of the market regime study that I've referenced in that video. And here is the current bull market, which I'm calling the 2020, we'll call this the 2022 to 2024 AI bull. So I'm considering the start of it to be in October of 2022. And we had 2 corrections in between, and this bull market lasted for 1.8 years. So how does this 62% and 1.8 year advance compare to previous bull markets? Well, if we look at the most recent bull market before that, which I consider to be the post-COVID bull market, the one where we had all of the meme stocks like GameStop, and you had Zoom and Peloton, all going crazy and going parabolic. That bull market lifted the S&P 500 136%, but it only lasted 1.8 years, exactly the amount of time as this bull market here, 93 weeks versus 92 weeks. So as far as timing, this whole AI craze that we're in is quite similar in length in its duration. When you take that into context, this bull market, the AI bull that we're in now, where NVIDIA is the leader, is similar in duration to the previous bull market. Now, I haven't done all of the bull markets in between. There's many to do, and I'll be doing videos on that as I get around to it. But let's look at our 1950s bull markets that I've studied, and we'll see how long they've lasted. So the 49 to 53 bull market went up 96%. That lasted 3.6 years. We had the 53-57 bull market last 2.9 years, 118%. We had a bull market in the middle of or towards the end of the 50s that went up 53%, lasting 1.6 years. Yeah, that one was a little bit choppy, according to my notes there. The 1960s early bull market go almost 40%, 1.1 years. And then we had the Kennedy administration bull market, 72%, lasting 2.6 years. So I would say that this AI bull is quite normal. It's had a pretty good run, and 62%, it seems a little, well, you know what, that seems quite typical because a bull market will probably get anywhere between 40% at the low end. A lot of them seem to be between 50 and like 130 or so percent, something like that. So I would say that right now is probably a good time that this bull market that we're in might be getting tired and about to change over to a new market regime. So by market regime, I'm referring to my investment theory that the stock market goes through different shifts in mindset, where at certain times you're going to have a lot of money flowing into the stock market, and that's a bull market. And then that there's other times when sentiment is very negative and you have a very long decline in the stock market and money flowing out, which is a typical bear market. But my idea is that you could easily see the boundaries of when a bull market or bear market begins and ends. And this is characterized by economic conditions that change and just a general shift in the way people view investing. The whole reason that I'm doing this bull and bear market cycle is that I want to get a better understanding of what the market looks like when it's about to go through a mindset shift. In that way, you could possibly time the market and avoid a mistake such as buying into a bear market. Understanding what the mindset shifts look like could also help you spot regular corrections that might actually be good buying opportunities during a bull market. And it could also help you avoid falling into the bear market rallies where the market comes back very strongly and then falls down to new lows in the middle of a bear market. So have we turned the corner, and are we now in one of those times when the sentiment is going to shift in the overall market and we're beginning a bear market? I think that might be possibly true given some of the events that happened this past week. First of all, let's take a look at some of the disappointing earnings reports that came out. So the first one I want to note is Microsoft, which came out with a generally good quarter, but the cloud service revenue was a little bit below the analyst expectations, $28.52 billion versus the analyst estimate of $28.68. Those are still huge numbers, but if they fell short of expectations, could that possibly mean that companies are now being a little bit frugal on their IT expense, in particular their cloud expense? Well, Amazon had disappointment as well. The overall revenue number missed the sales estimate, but also the AWS cloud services took a little bit hit as well, with the profit margins being below expectations and coming in a little bit lower than last time. And then we also have McDonald's, which had a decline in same-store sales, first time since 2020. Here is the chart of the same-store sales for McDonald's. Could this be an indicator that the U.S. economy is in a recession, or maybe even a global recession? This week, we also had an FOMC meeting where the Federal Reserve is leaving interest rates unchanged, but signaled the possibility of a rate cut in September. The Fed funds target rate is currently at 5.25 to 5.5%. Now, an interesting thing is going on with the yield curve. The 10-year and 2-year inversion is starting to revert. It is believed by some investors that when you have an inverted yield curve, that's a recessionary signal, but the actual recession and declines in the stock market don't actually begin until you start to see the uninversion of the yield curve. Let's take a look at this from a time series view. Here's a chart of the 2-year and 10-year. As you can see, they are closing the gap. Now I want to take a look at the trading action on the SPY ETF this last few days. You can see here our peaks here set on July 16th, and we had a little bit of pullback to the trend line. And this looked like it could be a normal sort of correction or just a little bit of the tiring of the momentum, and we continue on the course and it pulls back up, just kind of like what we had here in April. But then something happened on Friday. We got this nasty candle right here where we broke the downtrend line and we had a very vicious gap down. Right now, though, the SPY, which is an approximation for the S&P 500 index, is only off by about 5.71%. If this actually goes down, like let's say 20% from the highs, what would that look like? A 20% decline, if this were a true bear market, could bring us all the way down to like the 450s. So we'll be probably looking at some action going like that, but over probably the next 6 to 12 months maybe, if this is a real bear market. Remember, the last bear market that we had in 2022 went down about 23%, and that took almost a year for it to play out. Now let's take a look at the shorter time frame charts. At the beginning of the week, I actually thought this setup looked pretty good. We had a little bit of bounce here and then a double bottom. It looked like we were set to continue moving up. Here's the action that we had on Wednesday, 7/31. This nice little ramp up corresponds to the action that we see here. When the FOMC results came out, it was right here. There was a little bit of a dip, but then the market continued on its trend and continued to move up. I actually thought this was very bullish. Things changed the next day. We kind of had this topping action here where it couldn't get past 555, and then the entire day was pretty nasty of a down day. I've often found that when you have a Fed meeting, the actual result of that Fed meeting, you don't really see play out in the trading action in the hours right after to the market close going. You don't really see the trend that the market's going to take right after the Fed meeting in that time between when they release the FOMC decision and the market close. What's really telling is what happens the next day. And maybe that's because when the people who are going to make decisions with the big pools of money, they're not going to be trading that quickly based on the Fed information. They're going to wait until they discuss it in the evening and in the morning before they make their decision whether they want to pull their money out. So by the next day, you see the actual direction that the market is headed. And the Thursday following was actually a very bearish day. But then things got really bad on Friday. We had a nasty gap down. And a lot of this is attributed to the jobs report that came out on Friday morning. In the jobs report, non-farm payrolls were trending lower and came in below estimates. 114 versus the analyst estimate of 179,000 job ads. But as Lance Roberts said on Thoughtful Money this morning, today I'm filming this on Saturday, we're actually still hiring, so this isn't fully recessionary yet. If we were losing jobs, that would be a pretty big deal, but things aren't completely bad, but the trend is in the wrong direction. Also, the unemployment rate edged a little bit higher to 4.3%, and that is significant because it triggered something called the SOM rule indicator. The SOM rule is this recession indicator invented by a Fed economist named Claudia Sahm. So SOM indicator is when the unemployment rate goes over 50 basis points relative to the minimum 3-month average over the previous 12 months. So here there's a Fed chart that kind of charts this out and shows you the baseline of the previous 12 months 3-month average and the current 3-month moving average. The 3-month moving average. When that unemployment rate came out, it triggered it at 0.53 above. So the SOM rule, which is suggestive of us being in a recession, just flipped on. It's quite possible that we are in a recession right now because the Bureau of Economic Analysis, which looks at GDP, historically they do many revisions of the GDP numbers, and so sometimes recessions don't really get declared or noticed until months after the revisions are done. So what do I think this means for the stock market and where it's headed? And where's it going to open on Monday and next week, and what is the action going to be like? Well, I think based on my experience watching the markets and studying the charts, I think that there's a possibility that Monday is going to be another bad day. If the panic actually sets in and more people are selling, we might even get another nasty gap down. For example, here's some of the gaps that we've had in the previous bear market cycle. Look at 2022. We had a gap down right here and then another vicious gap down. And then here's another example where we had a momentum, a little island here as the market was gapping down. That lasted for a few days though, where it took some time to play out. However, early in that market, we had a nasty day from the top, and then 1, 2, 3, 4, 5. We had about 5 days where the market bounced back a little bit before doing the next leg down. And that's typically how bear markets seem to work, is that it's not always a straight line down because you have dip buyers, you have short sellers that are covering positions, and then you get these very strong bear market rallies. So it kind of zigzags on its way down. It doesn't get there right away. I think given that we're in the early stages of it, that the economic realities haven't really set in yet, and some people may even be discounting exactly how bad some of these indicators are, we're probably going to have some dip buyers come in, and there's probably going to be a little bit of a bounce at some point next week. But if we do get that, I'm probably going to be selling what I have because, in my opinion, and this is just my opinion, I think the yield curve uninversion and the Claudius-Sohm rules are pretty good indicators of where the economy is headed. And the stock market being a forward-looking apparatus, sort of a leading indicator on where the economy is going, that's probably going to go down before we get the worst of the economic news. And usually, as I remember back in like 2009, when we had the really bad economic news and there was a lot of hopelessness and despair in the general public, that was in early 2009, that was actually the bottom for the stock market and the beginning of a bull market. The world was pretty crappy as far as the job market goes through 2009 and 2010, but the stock market actually had a pretty good run. So if we're about to enter a recession, I think the stocks are going to go down in anticipation of that when we're in the worst part of the recession and people have thrown in the towel and they're not going to be doing stocks anymore. That's usually when you get to the bottom of the stock market, and then the recession goes on for a little while the stock market recovers. Speaking of which, why don't we take a little look at the 2007 chart. So I'm using the Thinkorswim backwards looking chart system. What happened in 2007? So here was the topping action that we had. Does this look similar to today? Well, maybe kind of. This is what the bull market looked like when it ended. We had a pretty vicious correction right here in the summer of 2007, and it topped out. But kind of like what I'm saying is that this took a very long time to play out. So you had your 2007 peak here in October. Yeah, interesting, October. And then it took all the way until, October of the next year was when things started to get really bad and you had Lehman, and that still wasn't over. It really kept falling then. So that lasted from top to bottom. You're looking at probably about a year and a half for it to play out. But like what I'm saying is that we had rallies here that looked like they were going to come back, retest the highs, but they didn't. We had these dips and then another leg up, and it looked like things were starting to get better. But this whole process of coming back and then failing and then coming back and then it goes down lower, that's the sort of stuff that grinds the retail traders down and gets people to quit the game. Once you get down here where you have a Lehman Brothers type of catastrophe, that's what really scares people. But I really think that the federal policymakers have, I don't want to say learned from this, but this action that we had here after the Lehman Brothers catastrophe sort of changed the way that the government approaches the stock market. And at some point, you could probably guarantee that if things get bad enough, the Fed will step in with another round of money and inflation for everyone, and the stock market will go up. Maybe the value of your dollars will go down, but the stock market will go up because the government will come in to rescue it at some point. Anyway, that's all I have for today. I hope you found this video be interesting and informative. If you want more, check out my other video on the 1950s bull and bear market cycles. And I'll see you in the next video.